When I raised my forecast to 5,000 and it didn't happen, people were, Schiff was wrong. Yes, I was wrong on the timing. We're going to get to 5,000, but because it took us so long to get to 5,000, we're going to 10 or 20,000. And it's because of all the extra inflation that has been created from that initial 5,000 gold prediction to now. And not just the inflation that's been created in the past, but the inflation that is about to be unleashed in the future. Because my other prediction is after the Fed starts cutting rates,
gold and silver markets are entering a pivotal moment as the Federal Reserve prepares to cut interest rates, a move that will reshape the landscape for bonds, the dollar, and tangible assets. While many investors believe these cuts will fuel another round of stimulus-driven growth, similar to past cycles, this time may be different. Inflation has already been unleashed, and with each cut, the Fed signals it is willing to sacrifice the value of the dollar to protect employment and financial markets. This is where the bond market faces the most significant risk. Lower rates and rising inflation erode returns, making U.S. debt far less attractive to global investors. In contrast, gold and silver stand to benefit directly, as central banks and individuals alike seek safety in assets that cannot be debased. PeterSchiff, a well-known economist, author, and CEO of Euro-Pacific Capital, has spent decades warning about the dangers of unchecked monetary expansion, excessive government debt, and the inevitable loss of confidence in fiat currencies. His forecasts often focus on gold as the ultimate hedge against inflation and currency debasement, positioning him as one of the most consistent voices in the hard money camp. As Schiff emphasizes, the setup we're witnessing isn't the end of the gold and silver rally, it's just the beginning. With the Fed preparing to cut rates into an inflationary backdrop, the stage is set for precious metals to accelerate much higher. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
And that is going to be very frustrating for the Trump administration and for the Fed. Now, some of you may say, well, gold is rallying. Silver hit a new 14-year high today. Finally, gold didn't. I mean, gold has been a little subdued the last couple of days. It's trading around 3,635. Oh, by the way, just this week, gold finally hit an inflation-adjusted all-time high. Now, not real inflation, but whatever the CPI adjustment is. We finally took out the $825 high from 1980. But this is not the end of something. This is the beginning of something. We are just getting started here in gold and silver. But gold and silver are also rising into this rate cut. And you may say, well, Peter, if you think that it's going to be a buy the rumor, sell the fact for bonds, why wouldn't the same hold true for gold and silver? Maybe gold and silver will sell off on the rate cut. Possible. It's possible. But I don't think it's that probable. Because even though gold and silver have rallied, I don't think they've rallied nearly as much as they should. But also, there's a big difference between the gold trade and the bond trade. Rate cuts are bearish for bonds. Rate cuts are inflationary. It means the Fed is turning its back on 5% inflation. That's probably going to become 6 or 7, and is instead choosing to die on the hill of employment and fight that battle. To hell with inflation. So once the Fed does that, that's a big signal to get rid of your bonds, right? Because the biggest destroyer of the value of bonds is inflation. And of course, rate cuts mean a weaker dollar. So why should foreigners want to buy our bonds if we're going to repay them with dollars that are worth less in their own currency than the dollars they loaned us, especially when we're reducing the rate of interest that we're paying them? So these rate cuts are bearish for bonds. So even though bonds have rallied on anticipation of the cuts, the event they anticipated is actually bad for bonds. So they shouldn't be rallying. So that's another reason why they should sell off and why they probably will sell off. On the other side, rate cuts alongside of rising inflation are the most bullish thing you could have for gold. So gold should be rising in anticipation of these cuts. and it should keep rising following the cuts. Because as people want to get out of their dollars and get out of their treasuries and mortgage-backed securities and whatever else has got a dollar coupon and a dollar principal payment attached to it, what are they going to buy? Well, if you're a central bank, there's really only one choice, and that's gold. So the central banks are going to be loading up on gold as they're unloading on U.S. dollars and treasury debt. So gold and silver should keep rising, even if there's a slight buy the rumor, sell the fact move on a rate cut. But again, I wouldn't even wait for that. Don't even try to be tricky. As I've been saying, you got to buy gold and silver. You don't wait, you just buy it. If you don't have it, you need it. And if you have some, chances are you need more, right? So you got to go to Schiff Gold. I mean, I like a broken record. And again, people can say, well, Peter, don't you make money when we buy some gold and silver? Yeah, I make a little money. I got plenty of money. The reason I want people to go to buy Schiff Gold is because they need to own it. I mean, I've been telling people you got to own gold for 25 years. Look where it is. It started. It was under $300 an ounce when I started. Look where it is, right? There's a reason that I want my followers to own gold and silver. That's why I set up Schiff Gold. I set it up because I was telling people to go buy gold and silver, and then they would go buy it and get ripped off. So the reason I'm telling people to buy their gold and silver from me, it's not just because I make a little money, but because I know you won't get ripped off. And you don't get ripped off because I do make a little money. I don't make much, but I make it up on volume, but I don't make it on each individual transaction. But I want my followers to own gold and silver because I don't want them to go broke, right? I want the people that listen to me to have money. Right? One day we're going to need that money to help out the people who don't listen to me, which, unfortunately, they far outnumber me. The rationale is the Fed's going to cut, so that's great for stocks. But people also think that the rate cuts are going to help the economy. They're going to help the housing market. They're going to stimulate because they look back at prior episodes where the Fed has started a rate cutting cycle, whether it's 2001, 2002, after the bursting of the dot-com bubble, whether it's 2008, 2009 with the financial crisis, or 2020 with COVID, right? Every time the Fed has slashed rates and printed a bunch of money, right, things have gotten better. At least they appeared to have gotten better, and the markets went up. So people are just hoping that it's going to work again. But I think they're wrong. Now, admitted, I wasn't sure it was going to work as a result of COVID. And it didn't, because we finally got the big pop in CPI measured inflation. So I nailed that, right? When everybody else was talking about how COVID was deflationary, I was saying it was the most toxic combination of, or most inflationary combination of fiscal and monetary policy ever. So we did get the breakout in inflation, but we didn't get the breakdown in the economy or the bond market, which I think is coming next. So I think that this time, this stimulus is going to act as a sedative. Now, the yield, if you look at the yield on a 10-year Treasury, it's now back down to just about 4% even. We had gotten as high as about 4.5%. The yield on the 30-year Treasury is about 4.65. That had peaked up above 5. Now, this rally in the bond market is in anticipation of these rate cuts that we're about to get. My forecast, again, is that when we get those highly anticipated rate cuts, it is a buy the rumor, sell the fact, and the bond market goes down and long-term interest rates, including mortgage rates, go up. And that is going to be very frustrating for the Trump administration and for the Fed.
Gold has quietly been outperforming for decades, yet the broader market continues to overlook its role as the accurate barometer of value. While stock indices climb in nominal terms, their performance against real money tells another story, one of persistent decline. The current setup resembles the 1970s, but with far worse fiscal foundations. Back then, the United States was still a creditor nation with trade surpluses and a manageable debt load. Today, deficits run into the trillions. The national debt nears $38 trillion, and short-term obligations dominate the government's balance sheet. Against that backdrop, The combination of expansive fiscal policy and monetary easing promises an outcome even more destructive than the inflationary decade of the past. Those who position themselves correctly could stand to benefit. Commodities, foreign equities, and especially precious metals are poised to thrive as policymakers prioritize growth over stability. Gold targets that once seemed ambitious now appear conservative, with the potential for prices to exceed earlier forecasts far. The likelihood of renewed quantitative easing adds further fuel, ensuring that capital will continue to flee into hard assets. Let's get back to the interview.
But in another year or two, I think we will be. I think we'll be outperforming for 20 years. Look, gold is outperforming for 25 years, right? It's just the gold stocks that have been lagging. My recommendation to buy gold 25 years ago has given you a better return than buying the S&P 500, even with all the dividends. That's how much the price of gold has gone up, or in other words, how much real value the U.S. stock market has lost. That's what gold is telling you, right? It's a real barometer. It's real money. And yes, stock prices are going up in funny money, but they're going down in real money. And they're going to go down a lot further, because what we're about to embark on now, I think that this Fed, especially as it gets stacked by the Trump administration, right? This Fed and this administration are going to pursue the most inflationary monetary and fiscal policy combination since the 1970s, maybe even worse than the 1970s. But it doesn't even have to be worse. The problem is our fiscal position is worse. In the 1970s, we were still running trade surpluses back then, right? We weren't fighting an unwinnable trade war because we have, trillion-dollar trade deficits. We had surpluses. Back in the 70s, the United States was still the world's biggest creditor nation. Now we're not just the world's biggest debtor nation. We owe more money than all the debtor nations of the world combined. So we are in a horrible fiscal position, right? The national debt was measured in the hundreds of billions back in the 70s. It didn't even get to $1 trillion until the early 80s. Now it's, approaching $38 trillion. The operating budget is $2.5, $3 trillion a year. Look, and we have this mountain, this balance sheet of short-term debt that didn't exist then. So we're in a much worse position now than we were then. So I think that the implications of the policy that we're going to get is going to be much bigger. So the average Americans are going to suffer more than they did in the 70s. And it was a lot of suffering. I mean, people had the real value of their wages go down. The reason that so many women entered the workforce in the 80s, it was not because they felt liberated and they went and got jobs. They were liberated when they didn't need jobs. What happened was their husband's paycheck lost so much purchasing power during the inflation of the 70s that he could no longer afford to support the family with his wife staying at home. So they had to go get jobs, right? A lot of people that were planning on retiring couldn't retire because, the cost of living went up so much. But what's going to happen now is going to be worse. But also, people made a lot of money in the 70s if they bet right. And betting right meant not betting on what worked during this go-go 60s, which was the Nifty 50, which was the S&P 500, the one decision stocks, Xerox, Polaroid, right? I mean, they had a bubble in the 60s. And a lot of people didn't recognize that the game changed in the 70s. What made money in the 70s? Gold, silver, oil, commodities, foreign stocks, the exact portfolio that we have now for our clients. Yes, I started creating these portfolios too early because I saw this train wreck coming from a mile away. But because it's taken the train so long to go off these tracks, it's going to be a bigger wreck. I think we're going to make even more money than I first believed on our foreign stocks, and in particular, our gold stocks. People made fun of me because I predicted $5,000 gold, back in 2010, 11, or whatever, and it never got there, right? Although they forget that when gold was under 300, I was predicting $1,000 gold, and people laughed at that, and we went way through that. But when I raised my forecast to 5,000, and it didn't happen, people were, Schiff was wrong. Yes, I was wrong on the timing. We're going to get to 5,000, but because it took us so long to get to 5,000, we're going to 10 or 20,000. And it's because of all the extra inflation that has been created from that initial 5,000 gold prediction to now. And not just the inflation that's been created in the past, but the inflation that is about to be unleashed in the future. Because my other prediction is after the Fed starts cutting rates, they're going back to QE. Now, I had thought that maybe they would have gone back to QE already. That's something that I had been saying. And, they've been able to hold off on that. But they're going to go back, right? Yes, they were able to resist longer than I thought, but ultimately they're going to give in. And what's going to be the pushing point is going to be when the rate cuts don't deliver relief on the long end. In fact, when we get the reverse, when lower short-term rates equal higher long-term rates, that's when they crank up the presses with quantitative easing. And then everything else that Trump is doing, the semi-phony privatization of Fannie and Freddie is going to flood the economy with cheap money and credit for the housing market. That's pure inflation.
Markets are entering a phase where the disconnect between reality and perception is widening at a dangerous pace. We're seeing the same patterns repeat, policymakers turning to rate cuts and liquidity injections as the supposed cure for every slowdown, while debt continues to compound at an unsustainable rate. The rally in bonds, the surge in equities, and the quiet but steady climb in gold and silver all point toward a more profound structural imbalance. On the surface, it appears to be growth and optimism. Underneath, it's the erosion of purchasing power, the hollowing out of real value, and the slow-motion recognition that the dollar's role is weakening. Central banks across the world understand this shift, which is why they're increasing their allocations to gold while reducing exposure to U.S. treasuries. That trend is not temporary. It's a reflection of diminishing trust in American fiscal and monetary discipline. Inflation may ebb and flow in the short term, but the policies being pursued ensure its persistence over the long term. Every cycle of easing further undermines the credibility of the system, and the result is not more stability, but more volatility. We are only at the beginning of a much larger move. Gold and silver are signaling structural stress that equities are masking with euphoria. History shows these divergences do not last forever, and when the balance finally shifts, it will be swift. That's why it's crucial to continue monitoring these signals and to understand their implications for the broader context. Share your thoughts about PeterSchiff's analysis in the comment section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.